The S&P 500 just hit all-time highs. Is it sustainable? Will it continue? Let's dive in. My name is Brian Cannon, and welcome to Markets in 5. All right, I got a couple of charts I'm going to plan to go through today, but let's start off with the S&P 500. So this is the daily chart going back just a couple of years. But you can see that, this is why we haven't been worried about the market. It's just been, trending up, higher highs, higher lows. And what supported that is the moving averages. I mean, we've had a couple of times, last year that the 20-year dipped below the 50, but then corrected and kind of headed back up. And we just recently, on this most recent little pullback here, had the 20 drop below the 50, but it's already started to curl back up, and the market's already made new highs. So we've got, RSI, took a little dip down during this little pullback, but again, it all stayed within kind of the range of acceptability as far as the uptrend goes. So we didn't make any real major moves on that. But RSI has now popped back above the 50, and you've got the MACD, which then crossed over and is heading up as well. So moving averages are all telling the story, and that is that the market's continuing to head up. We just broke out to all new highs on the S&P 500. So we do have this ascending wedge, which is starting to form. So over time, that can lead to a breakdown, but that's one of those indicators you watch, but you don't necessarily make any major moves on until it breaks to the downside. So as of right now, the market trend is giving the green light. This is another view of the S&P 500 on a weekly basis. However, it takes some of the gyrations out of the market and shows a smoother kind of longer term trend. And we compare that against the 40-week moving average. And as long as the S&P 500 is trending above its 40-week moving average, it means that the market's doing pretty well. It's doing what it should be doing, which is heading up. It doesn't mean it's not going to bounce around a little bit, but as long as it's above that 40-week moving average, the coast is clear. So you can see back here in 2022 when it broke down below that 20-week moving average and stayed below it, the RSI was down and the market was obviously down. When it popped back above it, everything was back to moving smoothly. Now you can see that we do have a slight negative divergence here between the price action of the S&P versus the kind of the waning RSI. So generally speaking, before a pull down, you can see that historically speaking, when you have higher price action and lower RSI, a lot of times it does precede a pullback. So is the pullback significant or is the pullback mild? You don't really know at this point. And right now you can't get ahead of it. The negative divergence could last for quite a while before it actually comes into play, if it comes into play. So it's just, again, one of those things that we keep our eye on. But again, the MACD usually also has a negative divergence prior to the pullback as well. So we are watching this closely, but the important thing here is to not really get in front of it and not try to time it, because you really don't know. But ultimately, keeping an eye on that 40-week moving average on this chart. Here's a chart of the S&P 500 relative to the 10-year Treasury yield. And you can see that generally speaking, when the Treasury yield has kind of a violent move to the downside, the S&P generally reacts kind of the same, but to the upside. So when we have a real strong move down on the Treasury yield, you see the S&P go up. So historically speaking, this is a relationship that's interesting to watch. And so this most recent move of the S&P 500 to make all-time highs came on the back of the Treasury yield having a pretty steep drop. So it has, lipped around a little bit and started to turn up. So we're watching the Treasury yield as well, because that could certainly have an impact on the market. So in wrapping up, I think ultimately no one knows, but I think the market's going to end up okay this year. I think there's going to be a little bit of volatility. There are some warning signs that we need to be obviously paying attention to, but other than that, it's why we play the technicals. It's why we do quantitative trading. We take the emotion out of the trade. So, but if you have any questions, give me a shout and I'll see you on the next Markets in 5.